Oh, it seems that I was muted. How everyone's doing? Thank you for being here, guys. It seems that I was muted, so let's wait for some more people to join. Hello, man. Hope you're doing fine. Let's wait for more people to join to start. It's been 4 weeks now since I started the live streaming with Gem Hunters. It's been amazing. A nice people, nice community. I really like it to be here. Hello everyone. How's the markets treating you so far? Bitcoin going up a bit, right? Nice to see that those movements happening, especially for the overall price action, because it was not a nice price action happening in the past few months. So to see some more volatility is actually nice. All right. Hello, Asma. Hope you're doing fine. How's everyone doing? Leave me in the chat if you guys can hear me, if you can see everything I'm showing right now. Let me know in the chats. Hello guys. All good. Amazing. Okay. Everything is perfect. Awesome, guys. Awesome. Let's do it. Let's start then. All right. We have already 30 people, I think. So this is nice. Okay. Thank you for being here, guys. Thank you very much for joining. This demonstrates that you are willing to learn, that you are willing to take the step to learn how to properly trade, not only from my side, but from all the Gem Hunters analysts that are constantly preparing and teaching you content that it's really hard to find online. And even if you find it, it's really hard to comprehend it at first, because there's a lot of information out there, misinformation, in my opinion, that you can get just messed up your head without proper terminologies, proper expectations of the content. Because nowadays we see a lot of people talking about trading, talking about crypto, talking about forex, whatever market. Some of them are real, some of them are not, on how they make their fortunes. And you shouldn't believe everything you hear in the internet, to be honest. And to have a group like Gem Hunters, in which you can share with similar peers like yourself, with people that are already on the level you want to be in the future, it's nice. It's really nice, and you guys need to really appreciate what you have here. All right. So let's start. Today live stream is about price patterns. Okay. I'm pretty sure you guys have seen this. Let me go over here. Okay, and let's go to another screen so we don't mess this up. Hello everyone, thanks for joining, guys. Okay, now let's erase everything over here and let's go. So I'm pretty sure you guys have seen the most common patterns, right? Like you have the flag, you have a rising wedge, you have falling wedges. What also normally have? We normally have also like triangles, double bottom, double tops, or double bottoms, and many others, right? I'm pretty sure you guys are really familiar with this type of patterns. Normally, because these are the ones that normally get shared online. All right. But if you have traded enough to know that these patterns actually don't have a strong win rate, okay? This doesn't mean that they don't work, because they do, but they don't have a strong win rate. All right. And this is mainly because people that normally trade these patterns, okay, unless they do it with the overall context of the market and not just finding the patterns and trading in whichever direction the chart is telling you. They normally find themselves with the problem of liquidity and volume. And what do I mean by this? Is that price is always chasing liquidity, like I have told you guys already several times. All right, price is always chasing liquidity, and volume is what happened in the past in the price, but there are certain volume areas that price acts like a magnet for price. All right, and normally these areas and this liquidity lies around these kinds of patterns, tops and bottoms. Okay, normally these kinds of this liquidity lies around these kind of patterns, both on tops and bottoms, and normally I'm pretty sure you guys have seen something like this. Let me erase everything I did here. So for example, we have a wedge formation, all right, a rising wedge, a falling wedge, sorry. All right, and you say like, oh nice, let's say Ethereum, it's on an uptrend, right? So as soon as I get this movement, I'm going to go long. I'm going to place my stop loss below this level, expecting obviously for price to reach this and possibly higher, right? But I'm pretty sure you guys have seen something like this. Price do this, then do this, okay? Then consolidates a bit more, and then it starts going in the direction that you desired, right? This is because there was a lot of liquidity here and here, and also there was a lot of liquidity below this because of all of the traders that long this breakout. So price came here, filled a lot more orders than it was actually filling from this breakout level, and then these orders make the price continue to the desired direction that everyone was looking for. Okay, same for example, double bottoms and double tops. Okay, so for example, we have this price, then you see this, and then you see this, and you wait for a breakout, you enter here, right? And price just do this. It takes you out, takes your stop loss, and then continues into the desired direction. Same for double tops, right? Price is doing this, whatever. Double top, you see this, you enter your trade on the breakout, price starts going a bit down, then continues to the upside, take your stop loss, and then continues on the desired direction. All right, so today we are going to see patterns that are aligned with the overall order flow of price action. And what do I mean by that is we're going to trade these movements. We are not going to longer trade these kind of movements. Okay, we're going to trade the movements that are actually happening after a lot of people and a lot of liquidity has been taken out of the market. Okay, so for this I want to show you guys the following. All right, so we are going to see several patterns. The first one, is called V-shape reversal. All right, let's put this in bigger, and all right, the second one, okay, it's called 3-drive pattern. Okay, the next one, it's called stacked orders. We have like 5 patterns that we're going to see today. The next one is the over and under pattern, or Quasimodo. Okay, and the last one I think is the FTR pattern, which is failure to return. Okay, and we are going to try to understand the significance behind these patterns and why they actually work better than traditional textbook patterns like double bottoms, double tops, wedges, triangles, butterflies, whatever. Okay, so Let's start with this. All right, let's start with the B-shape reversal. Okay, guys, if you guys have any questions, please let me know on the chats. Okay, I will try to answer them during the stream or after I'm finished with the explanation. Okay, so let's start. Let's start with the B-shape reversal. All right. So normally the B-shape reversal has this this structure. All right. You see a big move to the downside, and then a quick move that recovers this decline, then a possible pullback, consolidation, and then continuation to the other side. All right. So for a B-shaped reversal, the first characteristic that we have for this pattern is that it normally shows bottoms and tops. Okay, this doesn't mean that they can happen on a trend following environment. They do happen, and they are actually the most profitable ones, but this kind of pattern normally shows up in tops and bottoms. Okay, why is this, and why this pattern is more significant than a double bottom, for example, or a double top, right? This is what happens here. So this movement to the downside normally is triggered. Okay, this movement to the downside is normally triggered by some fundamental news or some quick crash in the market, some slingshot that happened over a New York opening, or something that brings volatility to the upside. Okay, and what happens here is that below this level, okay, or possibly there was another level before that that hasn't been interacted yet, like for example, price was doing this, oh sorry guys, price was doing possible a range formation over here, right, before it went down. Okay, so you have a level in which a lot of liquidity is resting below. All right, so we have this move that gets triggered for some fundamental reason or for some volatility reason, right? It takes all of this liquidity out of the market, right? And then all of the sudden the market turns to the opposite side. Okay, all of the sudden the market turns to the opposite side. And what does this happen? What does this make? Right? Is that the previous high that made the new low, right, gets broken over here. Okay, shifting the overall price structure. So this is what we call a price structure shift. Okay, and since we have this price structure shift, this means that the momentum has shifted from bearish, and from which all of this liquidity was taken out. And also is something important to say, that we are going to have a lot of trapped shorts here, tons of trapped shorts, because retail traders, what they do when they see this kind of movements, they go straight and short this, right? Then the market reverses, and we have the stop losses above these regions where the market is now looking for right now, and then the market just continues in the desired direction and takes all of the shorts out. Okay, we are going to see live examples of this for sure as soon as we move into the charts. Okay, so this is the first pattern and why it normally works. Okay, because the movement that trapped traders, the movement that trapped liquidity, the movement that took out the liquidity from previous shorts or long positions has taken place. Okay, and now that it has taken place, it's now moving on the desired direction. All right, now let's go to the 3 drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-drive-dri Let's put this like this. All right. Now let's draw a 3-drive pattern. Okay. Let's do it on the opposite side of this B-shape reversal. So for example, I'm going to do something interesting here. So I'm going to continue with this price action until we find all of the patterns in the same price action. Okay, let's see how it works. So let's see price action continues. We have a consolidation here, then 1 taken, 2 taken, and 3 taken. After this, you're going to see a price structure shift, possibly a consolidation or pullback, and then a continuation to the downside. Okay, so what is this? Triple tap. We have one tap here, okay, we have one tap, second tap, and third tap. Okay, and this normally happens where possibly we have a resistance level over here. Okay, so you have 3 taps into this resistance, and from which each of these ones, as you can see, there was liquidity above these levels from people shorting near a resistance level. So this move to the upside and this move to the upside took all of those liquidity available, and then you have a price structure shift, okay, and then a movement to the opposite side of the trend. So as you can see, this pattern over here also normally happen when we have bottoms and tops, and it's really hard to find it on trend following environments. Okay, it's extremely hard to find it on trend following environments. This is most of a mean reversion pattern on tops and bottoms. Okay, this doesn't mean that you can find it, but you can actually find it, but it's really difficult for this pattern to happen on a trend following environment. Okay, so why this is important also, right? We are seeing that there's liquidity, right? We have liquidity taken from this move down. We have liquidity taken from these 2 moves ups, right? We have this triple tap, then the move down, and then a continuation to the downside. So as you can see, many people are just shorting here because they think like, oh, double top on resistance, short, right? And it doesn't work like that. What's normally going to happen is that you most likely will have a triple tap there, and that's why it's called a 3-drive pattern. Okay, now let's look at this pattern over here. All right, the stacked orders pattern. Stacked orders, and I'm pretty sure that you guys know this pattern because you are very likely to call them order blocks. Okay, what time frame do these patterns work best on? One thing that to understand, guys, is that patterns and price action is fractal. Okay, you can see these patterns on a yearly scale up to 1 second. Okay, it's not about the time frame by which they work best, but rather the context of the market in which they work best. What do I mean by that? Is that you don't go ahead and check the market and see one of these patterns and trade them all. It makes no sense. Okay, what you have to do is to check the overall context of the market. And I'm going to add that at the final of this presentation so you understand which are the procedures that you have to look for, okay, when finding these patterns. All right. So I'm pretty sure that you guys know this pattern over here, which is stacked orders, okay? And it's normally called order blocks. What are the requirements for a valid order block or a valid stacked order pattern, all right? So the first one is that it made an excess. I'm going to show you guys what is excess, okay? The second one is that it created a liquidity gap. And the second one is that it created a price structure shift or a price structure continuation. And or yeah, we have it like that. Okay, so let's continue. We have this over here, stacked orders. All right, what is a stacked orders? Where we can find them? Okay, we normally find these orders, right? Let me erase this. We normally find these order blocks, all right, in the previous movement before a structural change. What do I mean by that? Let's say we have something like this, okay, then a price structure shift happens, okay, market starts to consolidate, possibly going lower, keeps consolidating, then price returns to this level and makes this move, okay. And what do I mean by this? You see excess, liquidity gap, and price structure continuation or shift. Do we have X's over here? Yes, we do. Why does X's means that it has taken the liquidity from a previous high or low. In this case, it did. Okay, let's think of this as a single candle. Okay, let's think of this as a single candle. So this candle actually did an axis. Okay, then it created the move down for a price structure shift, because remember guys, we were bullish. Okay, and in the process of doing that, it left a liquidity gap. Okay, so this example is complying with these three main things that a stacked orders pattern should have. Okay, and why we normally use this is because after creating this excess, right, a lot of people are going to get trapped in thinking that the market will continue to the upside. Okay, then the market starts declining and a lot of traders will start jumping into the downside, leaving some liquidity over here, and then price just will come up again, take the liquidity that this order block, okay, or this order block or stack orders left, and continue to the desired movement while you are already out. But it's extremely important that you take into consideration that every order block has excess, liquidity gap, or a price structure shift or price structure continuation. Okay, now let's continue. Let's look for over and under pattern, all right? And we're going to make it in the other sense of this trend that we have over here, and it's working out. I really like this format because I'm not showing individual patterns but the overall market as you can see it, which is really nice. Okay, now let's look for over and under pattern or Quasimodo, right? So for this pattern, it has a real similarity with the most common head and shoulders pattern. Why is this? Because, for example, let's say we have a level of support over here. Okay, this is a support level. All right, then the market starts going down. People are expecting to long from this region. People start longing. People starts longing. The market is not going up. Then you see a movement like this. Then a recovery, shifting market structure, and then a continuation. And as you can see, we have left shoulder, head, and right shoulder. Okay, but why does this pattern work? Below these levels in which we can see a double bottom, right? this is a double bottom, actually. People longing from a support, then it comes the real move that takes all of that liquidity down, including the liquidity below this low over here. You see, low liquidity taken from this move. Okay, then the market reacts from here. Okay, the market reacts from here, and then it shifts market structure, but breaking above the high that made the new low. Price structure shift. And when you see this, okay, when you see this, you have, oh, I'm not going to erase this, but you have several options. Normally, price, when it breaks market structure, it leaves gaps, okay? But the easiest thing in what I do call universal limit entry is that you set, okay, an entry on the 0.55 of fifth. Why not the 0.618 or the 0.5? Because I have seen in my strategy that if you leave it on 0.618, which is a golden pocket, you normally get front run. And if you leave it on 0.5, it's very likely that you don't get filled. Okay, so let's leave it in the middle and put it 0.55. Okay, that's the reason behind it. Nothing extremely weird. Okay, so let me make this example again so we see exactly what happened here. So the market did a double bottom, right? People longing. It went up, then it went down to take all of the liquidity. Then the market starts going up, breaks market structure, breaks price structure, and then starts going down easily. Takes the over and under swing and continues to the upside. Okay, so this is what it's called the over and under Quasimodo pattern. All right, we have the over and under swing here. We have the over and under swing there. Okay, and we have the universal limit entry over here as well. Okay, the 0.55 from Fibonacci. Okay, and why this pattern works? Similar to the B-shape. It's really similar to the B-shape. The only difference from a Quasimodo and a B-shape pattern is that the move to the upside is not that aggressive, meaning that, as you can see, you have a move that completely erases the move down. Here, it takes its time until it breaks it and then returns easily, and normally returns to this level. A B-shape is not going to give you such a pullback. Okay, is not going to give you such a pullback. And now, since we had a resistance over here, right, guys? We had a resistance level over here. What is the most common scenario? Oh, let me add something here on the Quasimodo. 0.55 fifth level. Okay, so we have a resistance over here because this is the previous order block on this overall market structure that I'm drawing with you guys. Okay, we have an order block here, so this is a resistance level. So what does retail traders do? When price reaches resistance level, they often try to start shorting the market even though the market hasn't even reached there. And we often see, bearish pressure before reaching a resistance level. And what is the FTR pattern? It's just exactly that. Is a failure to return. And what does this mean? Okay, failed to return from resistance or failed to return from support. And what does this mean? That after this movement that we're going to see over here, you normally see a quick and aggressive movement breaking out from the resistance level, taking all of the liquidity available from the shorts that were stacking, okay, they were stacking below resistance or above support, okay. And then the way to trade this, okay, the way to trade this, I often don't found the tools that I'm using. Okay, over here. The way to trade this is you wait for this pattern, for this price to return where the FTR candle is. And what is the FTR candle? Either it's stacked orders, it's an order block, or it's one single candle that it's making this this movement to the downside. Is this what you call a short squeeze? Well, a short squeeze or long squeezes are happening in all of these patterns, as you can see, right? Why? We have a long squeeze here. People are long here. They set their stop losses below the previous lows, and then movement goes down. It's short all of the longs. It squeezes all of the longs stop losses, and then continues to the higher. As well here. A lot of people are short in a resistance level, right? Then the price just went, no, well, this is not an example for short squeeze. To be honest, yeah, the FTR makes more sense for a short squeeze, because in this scenario over here, we're seeing this high, and this high being taken from this movement to the upside, where people were expecting more downside from resistance. Okay, so the way to trade this is basically using the whole combination of what I showed you with stacked orders, okay, order block, and this is a breakout and retest, basically. Okay, so you wait for the market to come back down here, and it will most likely continue to the upside. All right, so these are the 5 patterns that I wanted to show you guys. Is this a swing trading strategy? No, actually, like I've said before, you can apply this strategy in any time frame. Price is fractal, guys. You need to understand that what happens on a monthly time frame happens on a 1 minute time frame. What happens on a 5 minute time frame happens on a 5 hour time frames. Okay, time frames are irrelevant. What is relevant is price, and its price structure. Okay, and the trend. The same price that you are seeing from a 1 minute perspective is the same price that you are seeing on the daily. It's exactly the same. Okay, so time frames are completely irrelevant for that. Now, what I wanted to show you guys is the pattern recognition flow for these patterns over here. Okay, so the pattern recognition flow, let me move this a little bit more. Let's put this here. Okay, so pattern recognition flow. Okay, let's put it in another color. And the first thing on the pattern recognition flow is first, which is the market context, right? Which is the market context? Is the overall trend bullish, like we're seeing in this example, right? Is the overall trend bullish? Oh, right. So I'm not going to look for shorts. I'm going to wait until a proper long setup presents to me. Okay. Market context, fundamentals. What's the narrative? How's the macroeconomic environment going right now? Okay. Is the market fearful? Is the market ecstatic? Are buyers and sellers what they are looking, right? Put yourself out of your thoughts, put yourself out of your mind, in which what you are trying to do every time you get into the charts is, oh, I'm going long, oh, I'm going short, or whatever, I'm going to trade. Okay, that's not how trading works. Put yourself out of that and start thinking what other people is doing. because markets are literally the representation of the psychological states of people and masses. Okay, so if you take 1 minute to just put your mind away and start thinking of what the people is expecting, what the market is expecting, what are the fundamentals, what are the technicals, okay, what is the context, what's the overall trend, then you will have a higher likely probability that your trade is going to go on the positive. Okay, so that's important to notice. What's the market context? Okay, second is a structure. And what do I mean by structure? I mean, is the middle time frame aligned and correlated with the higher time frame? Is the lower time frame correlated and aligned with the higher or middle time frame? Okay, a structure, guys, a structure, market context. And on structure, you have the top-down analysis. Because every single higher time frame is always more important than lower time frames. Trends start from lower time frames and end on higher time frames. Okay, so we give always priority to higher time frames. Always priority to higher time frames. Okay, the third is the pattern itself. Why? Does the pattern already took place? Right? If the pattern already took place, then you just need to wait for the next pattern to appear to take a trade. You're not just going to jump in at whatever price, because each of these patterns have entry points. Okay, why do they have entry points? Because we need the best risk to reward in order to have a profitable trading strategy. So all of these patterns have entry points, and the entry points, you can either use the universal limit entry, okay, for all of these patterns, right? Or you can use stacked orders or liquidity gaps to enter the market, whatever, okay, whatever. Everything works. Everything works. You just need to back test it. But if the pattern already took place and you see, oh, I missed an over and under over here, right? I'm pretty sure that's what you guys are going to tell yourselves. I missed this over and under, so I'm just going to enter because the market should start going up because it's coming from an over and under, right? No, you don't enter the market. You wait until this FTR happens and then you enter the market in this retest. Okay, that's extremely important, guys. So you see the market, the pattern, I am early or late. Okay. Early or late. And the last flow, the last part of the pattern recognition flow is the most important one. So is the trade and risk management. Okay, what do I mean by this? Is that you are always going to place your stop loss. Okay, always, guys. If you start doing this, you are going to get less stopped out, believe me. So your stop loss is always below or above excess. This is just a note over here. And I'm going to make it bigger because I know what you guys, I know how you guys are afraid of always your stop losses getting hit. Okay, always put your stop loss a lot below or above excess. What do I mean by that? Is, for example, if you enter a trade over here, where was the last movement that take liquidity from the market? This is the excess, and this is my stop loss, and I'm targeting probably this high, or this high. Right? You can set 3 targets if you want. Or if you are using a trailing stop loss, then you wait for market structure to change, then you take your stop loss higher, take your stop loss higher, and so on. Okay? Now, for example, here, in a triple tap, you have the price structure shift, you are setting your entry order, okay? on the stacked orders, where is the last excess? Last excess is not here on the on the 3 drive, is on the excess that it was made by the stacked orders pattern. So your stop loss goes above here, and then you target lower levels. Okay, if you are entering on a B-shaped reversal, where's the excess? Here, and then you target higher levels. And if you do this, even if you're not going to use this pattern, but at least you put your stop loss always below or above liquidity, hunts, excess, or whatever you guys want to call it, okay, because it's exactly the same, you are going to be less stopped out in the future. Believe me, guys. Because if you spot where these liquidity hunts happen or where this excess is happening, okay, the market is less likely to come back or to come back up or to come back down to those levels, because the liquidity there has already been taken. So there's not more magnet for the market to actually come to that level again. Okay, so that's what I mean by trade management. Okay, and we are going to see more tactics about trade management in future streams, right? Like trailing stop losses, soft trailing stop losses, trading without stop loss, which is not recommendable if you are a beginner, but also risk management, guys. Never, and I'm saying never, risk more than 3% of your account in one trade. Never do that. At least if you are a beginner. All right, believe me, you can make enough money just by risking 1%, 0.5%, and even less if you have a higher account. But if you're risking 2%, 3% per trade, that's fine. Always use the risk that you are allowed to yourself to lose in that moment. And how are you going to notice that? How are you going to notice that? If you have too much risk, you are going to feel anxious. And if you are not risking enough, you are going to feel FOMO. Okay, when you are anxious and you are in a position, that means that you need to turn your position size lower, because this way you are not feeling comfortable with what you are risking. So that's no point for you to feel anxious during the whole trade. And if you are feeling FOMO, is that you are not risking enough, because you are already in a position, the position is going way too good, and you only risk, let's say, 0.1% of your account. You see? So that's extremely important, and this is why the number 4 is the most important one, guys. Okay, you can use these patterns not even only to trade them, okay, but also use them as confluence for the overall market price structure. Okay, guys. So let me see if there are any questions. Okay, Kevin, you're starting? Okay, that's fine. You can check on the Gem Hunters YouTube previous sessions that I have done, that Crypto Data has done, and many other analysts have done for you to learn from scratch. Okay. I'm pretty sure that you don't understand this, but I'm pretty sure that if you see the previous 3 live streams that I've done, you are going to be able to understand this. Okay. And if you don't, then just tag me on Telegram and we will chat about it. Okay. So what you need. In the top-down analysis, which time frame should be utilized to determine the trend of the market? Nice question. Okay. Nice question. That depends totally on your trading style. Let's start saying that, as I have told you guys several times, time frames are irrelevant. Okay, so what do I mean by that? First, what's your trading style? Are you position trading? So your trades are open for 6 months, 1 year, 3 years? Are you swing trading? Are you intra-week trading? Are you intraday trading? Are you scalping? What are you doing? You have to set your boundaries. Okay? Only experienced traders can do like all the styles. I personally can do all styles. Okay, I can scalp, I can intraday trade, I can intra-week trade, I can swing trade, I can position trade. But I have 7 years of experience of messing everything up through all of their styles. Okay, but it's not necessary for you to do all of them to be profitable. I do it because I really like being on the screens. I like the markets. I like investigating. I like studying about the markets. If you are just here because you want to make some more income trading, that's completely fine. And that doesn't mean that you need to intraday trade or intra-week trade. It's possible that you just want to know how to position trade or swing trade. And you check positions every 1 week, every 2 weeks, every month. Okay, I do it because this is my career, this is what I studied, this is my passion, and this is what I like the most. I'm not only here for trading, I'm also here for all the whole financial technology that amuses me and I really like. Okay, but if you are not into that, that's completely fine. You better start with swing trading and you check your positions once a week or once a month. Okay, so the time frames that are more relevant depend on your trading style. I'm going to share what I personally use and you can take as reference. Okay, so for swing trading, I use the weekly chart, okay, the daily chart, 10-hour chart, and 1-hour chart. Which one is telling me the trend? The weekly. This is the primary trend confirmation. The daily is showing me the secondary trend. The 10-hour is giving me context. And the 1-hour is where I trade. This is how I swing trade. And you can apply this for all the time frames, right? You may ask why you use the 10-hour instead of the 4-hour or the 12-hour. Because I like the 10-hour best and time frames are irrelevant. Time frames are literally irrelevant. Okay? So that's for my swing trading. Okay? And normally what I do for swing trading, let's not call this swing trading. This is intra-week trading. Intra-week. My trades don't last more than a week, to be honest. So from the 1-hour perspective, I look for the pattern after the trigger, and I take the 10-minute for trade management. Okay, that's for intra-week trading. And for scalping, I use the same structure. Okay, it's same structure, only that the primary trend is coming from the daily. The secondary trend is coming from the 10-hour. The context and triggers are coming from the 1-hour. The pattern is coming from the 10-minute chart. And the trade management is coming from the 1-minute chart. That's for scalping and so on. What is my recommendation, guys? Never mix more than 4 or 5 time frames. It's not necessary. Actually, I have seen profitable traders trading with only three time frames or even just one. Okay, this is the way I do it, but you don't necessarily need to do this. So it's scalable and is exactly as it says. It's top down, right? If you are scalping, the weekly trend and the monthly trend is not going to help you. Okay. Risking 3%, what leverage do you recommend for beginners? So that's a very nice question, guys, because leverage, give me a second. Leverage included here in risk management, okay, is just a risk management tool. You can risk 3%. Okay, you can risk 3% of your account using 100x leverage or 1x leverage. It's exactly the same. When we are talking about percentages, leverage doesn't matter. What does leverage matters is that you are not using your whole account to take a single trade. What do I mean by that? Okay, let's say you want to take a trade on Bitcoin. Bitcoin right now is worth I don't know, I don't have the chart right now. So Bitcoin right now is worth $93,000. For you to be able to take a trade with one Bitcoin, you need $93,000 on an exchange, right? What does leverage works for is that if you don't have the $93,000, you, for example, only have 10,000, right? And you want to take a position on a full Bitcoin. What does that mean? That you need to use 10x in order to have $100,000 of purchasing power in order to be able to afford a one Bitcoin position. But that doesn't mean that you aren't risking a 3%, 2%, or 1% of your overall account. So leverage is just a risk management tool, not a tool by which I will win more or I will lose more. Yeah, definitely you are going to lose more if you use excessive leverage as well. You are most likely to have a margin call because your liquidation levels are pretty close to your stop losses or even higher than your stop losses, right? But at the end of the day, leverage is just a risk management tool. You have to use it for that. You don't have to use it for I'm going to win more money. No, that's not how it works. Okay, and if you are doing that, then basically you are just gambling with your money and asking a loan from the exchange so you can trade with more money and you will get eventually liquidated on your account. Okay. What is the easiest to start? Yeah, swing trade. Definitely swing trade. Okay. Swing trading is easier because you don't have to take decisions in small time frames when you're scalping or trading. Okay, so that's a huge difference. Like if you see an over and under pattern from a 4-hour perspective, it's going to take, believe me, weeks to happen. All right. If you see an over and under happen on the 1 minute, you're going to need to take quick decisions. If you're entering the trade, you have to calculate your position size in seconds. Okay, so it's always easier to start from a swing trading perspective. And if you start liking the game, then start going down. Okay, I have a lot of friends that are just swing traders and they make a hell lot of money from the market by taking one trade per 3 months. And you are here taking 100 trades in a week and you are not profitable. So this is not a game about how many trades are you taking and how active are you in the market. This is a game of consistency and applying the same strategy all over again in the time frame or on whatever time frame you're doing it. Okay. Awesome, guys. Yeah, I think we're done for today. One thing I would love, guys, is to see in the comments and you tag me in the comments and you start finding these patterns on Bitcoin, on Ethereum, on whatever asset. You're going to find them in all of the assets you want. Okay, find these patterns, tag me, and let's discuss about if you got it right or you got it wrong and why you got it wrong. Okay, so let's have these discussions more often on the chats because this way you guys practice and you have immediate feedback. So that's something that you need to take advantage of. All right. Awesome, guys. Thank you, Rafael. Thank you, Prabhasha. Sorry. Thank you very much for your time, guys. Really happy as always to be here and share time with you, sharing all of this knowledge. I'm pretty sure that it's going to be useful. At least this is what made me profitable in the market. So I'm pretty sure most of you are going to be as well profitable if you make it happen, guys. Okay. So see you hopefully next week for more information and for more insights about the markets. Okay. Thank you, guys. Bye bye. Bye, guys. Take care.